Welcome to the Synergy Sessions, Aging Smarter in Silicon Valley. I'm your host, Tom Nelson, and I know firsthand as a family caregiver and part of the sandwich generation how tough it can be to take care of your aging parents while balancing your own life, career, and family. We'll bring you the experts and information necessary to help make your life a little bit easier and you a little bit smarter. Synergy Sessions is brought to you by Synergy Home Care, bringing you personalized in-home care and peace of mind to Silicon Valley families. I really do hope you enjoy the show. Hi, everybody. Welcome to Synergy Sessions. My name is Tom Nelson, and we are here to help you age smarter in Silicon Valley. Today, we have Dan Biller, who is a reverse mortgage consultant with New American Funding, and we are going to talk about reverse mortgages. And when I started out thinking about the title of this, it's like demystifying reverse mortgages or really getting to the bottom of reverse mortgages. It seems like reverse mortgages is something a lot of people have heard of, but they really don't know much about or who it applies to. So I'm so excited to hear, Dan. Welcome to the podcast.
Thank you, Tom. I appreciate it. I'm excited to be here. And yeah, just to demystify and educate and have a good talk with you.
Excellent. So I think maybe to start off, so what is, a reverse mortgage consultant and your company, New American Funding, so what do you do in your role and what does your company primarily do?
Sure, it's a great question. So I'm a licensed mortgage loan officer, just like a mortgage loan officer that might get you a regular mortgage on a home. And really, reverse mortgage is kind of the same thing as a regular mortgage, other than the level of control. So what I do is I specialize just in reverse mortgage and specifically in a program called a HECM, a home equity conversion mortgage, which is a HUD and FHA program. It's regulated by HUD and insured by FHA, which a lot of people don't know. It's very regulated in favor of our borrowers. So I talk to people generally over age 62, but we can help folks down to age 55. I talk to their families, their advisors, anyone that wants to help them out with the process. And our main focus is really education, because you use the word
Okay.
demystify in the introduction,
Mhm.
and really, that's probably the biggest part of my job, is because everyone sort of has their own opinion that they've heard from their neighbor, they've heard on TV, or they've seen in the media. And so the actual education piece is really what's huge. And so a big chunk of my time is doing that. And
Yep.
people will see very quickly whether a reverse mortgage is the right path or maybe not the right fit for them. And my main objective is just to get them to that point and give the clarity. And, taking it from there, yes, we do applications, we do loans, just like a regular loan officer, and go through that
Got
whole
it.
process. But education is really the biggest piece of what I do.
Okay. Perfect. So that's a great segue. So why don't we start there with the education? What exactly is a reverse mortgage?
Sure. So a reverse mortgage is a lien on a home, just like a regular mortgage, that lets a homeowner pull equity out of the home to use for essentially anything they'd like. Could be for home renovation, aging in place, in home care. They could do pre inheritance for their children, help them buy a property. They could pay down or consolidate debt. All of it is allowed under the program. And all they have to do is live in the home as a primary residence and maintain property taxes, insurance, and any HOA. See, they have to stay current on their regular property maintenance. It doesn't excuse them from that. But what it does allow a borrower to do is pull the money from their home in the form of a mortgage, but there's no required payment, or we say it's a deferred payment for life. So they could pull that money out, live in the home for the rest of their life or until they choose to sell if they need to move out eventually, and not make a payment. And so if they pass away, yes, the reverse mortgage becomes due, or if they sell the home, a reverse mortgage becomes due. We do tell people nothing is free in life, but this program allows people to age in place and sort of attain their retirement goals, whatever they may be.
Got it. Great. So you were saying that they still need to maintain all of their normal responsibilities, just like in a regular mortgage. Because if you're starting out at the beginning of a mortgage, it's you mostly owe. But with a reverse mortgage, same thing. You're pulling equity out, and you don't owe as much or at all, except for what you're pulling out of the mortgage. So it's just the same type of dynamic. It's just which way the money's flowing.
That's
Instead of
right.
flowing to the bank, it's coming from the bank to them.
Exactly. So the lender
Got it.
gives them money if they choose to pay, the interest, because it does accrue interest, it compounds monthly, just
Hmm.
like a regular mortgage would.
Yep.
But if you don't make a payment, that interest will increase. So it can be used as a negative amortization, or people could choose to pay the interest and keep the balance flat, or they could treat it like a conventional mortgage and pay some principal if they chose every month. So they're really in the driver's seat. That's what differentiates it from a conventional mortgage. And when you're talking about people that are on a fixed income, which is probably 90% of the people I work with, or that's, their family members are on a
Right.
fixed income, having a lien on your home with a first mortgage in retirement, you're obligated to make that payment every month. And if you don't, we all know what
Hmm.
happens. That lender can initiate
Right.
foreclosure. And then we have seniors who go and take out equity lines on their homes. Not only is that a second lien on the property, it's a second obligated payment each month, in addition to health insurance, rising food
Right.
costs, home repairs, unexpected medical costs. So, the way that things are happening in our society, that relief sometimes can really give one of our active adults, the peace of mind they need to know I can make it through this month. If I have a little extra funds, sure, I can pay down on a reverse mortgage. They know that there's no prepayment penalty because HUD guarantees that. But if they have a harder month or higher expenses or a change in, their living situation, they know that they don't have to make a payment.
Hmm.
Um, and, I
Right.
just always explain to everyone, yes, if you don't make a payment on a reverse, the balance can grow, but you're in the driver's seat and you're in control. And I think that's a peace of
Right.
mind, just benefit, and sometimes a solution that's
Okay.
people are looking for.
Got it. Well, that's so you started venturing into one of my other questions is the fundamental difference between like a home equity line of credit versus a reverse is
Mhm.
that there is a so what are the differences between that or maybe some other conventional types of ways to pull equity out of their home? Because you're right. In my business in home care, one of the
Mhm.
biggest things is we have clients who may have a lot of equity in their home but are on a fixed income and they want to stay in their home as long as they can for many different reasons. So, one of the reasons why I thought it was great to talk, about reverse mortgages because it is a very viable option for them. But what are the fundamental differences between the other types of options?
Well, kind of like I mentioned before, if you had a homeowner with a first mortgage, that's one lien on a property, right? And then they take out an equity line to access
Right.
cash. That's two liens on the property and two obligated payments. A neat thing
Mhm.
with a reverse mortgage is you can combine a loan balance that's pulled out, the equity used, and they could still qualify for an additional line of credit all in the same program. HUD and FH made it
Okay.
all one entity basically. So it's only one lien on a property. It's a non-recourse lien, which means the lien is only against the home. Non-recourse means the lender
Hmm.
can't go after anyone else, not the estate, not the heirs, not the other assets of a homeowner,
Hmm.
or against the homeowner personally. A reverse mortgage is just
Got
a
it.
lien on a property. So again, the
Okay.
HUD guidelines really are protecting the homeowners here. The goal was not for seniors to lose their homes or banks to take their homes when they pass away. The goal was to unlock a relatively conservative portion of the equity. We usually only give between
Hmm.
40 and 50%, and that's age driven. The older
Okay.
you are, the more you qualify for to pull from the home. And the goal is keep them there as long as they would like to stay in the home. I'm sure that's what you see a lot with
Right.
your clients. They've got that emotional connection to the home, the time, the memories.
Hmm.
And so oftentimes, as people age, they want to be where they're comfortable. And for many people, not everyone, but for many
Yep.
people, that is in their primary home. So it puts the borrower in
Yeah.
control instead of the lender. With the HUD and FHA program, it's also FHA insured. Now, not all reverse mortgages are FHA insured, but that HECM program, HECM, whenever you hear that, that's the HUD FHA insured reverse mortgage. There are other programs out there,
Okay.
which I can educate people about, that are what we call proprietary or jumbo. They're an investor program. and we're a direct lender for them. We fund those as well for higher value homes. Over about 1.2 million is where there's sort of a breaking point if
Okay.
people need to access more funds. So
Got
it's not one size fits all,
got it.
but it's generally a much safer option for people on a fixed income that have
Right.
changing medical needs, that have care needs, that have renovation, home improvement needs. They need to keep up with their property. A lot of people I talk to have had their homes for 40 years. We're based here in Silicon Valley, and a lot of the homes were built in the 60s and 70s, and many of these people have been in there
Mhm.
since then. So they need a lot of updates. And that's true nationally as well. Just as a general concern, tripping hazards, narrow hallways, bathrooms that aren't
Right.
retrofitted, kitchen counters that are the wrong height. A lot of people will use funds to correct all of those things for aging in place.
Right. No, that's a great point. So not only staying there, but kind of retrofitting to make sure it's safe to stay there as well,
Mhm,
which is really critical because they don't wanna create new problems for themselves.
mhm,
But that you brought up a couple points because I think I was even unclear on some of the things. There is a restriction on how much they can take. So it's just
mhm.
not this open checkbook to just get to the end of the the equity,
That's right,
and then so
yeah.
what happens so if they hit that wall, are they they have to make a decision at that point whether to sell or do something else with the house once
Right.
they've hit the maximum amount from a reverse at least from a reverse mortgage standpoint,
Mhm.
they maybe might be able to do some other things, but they're maxed out with you.
Yeah, a borrower could pull everything out that they qualify for, and when that money's gone,
Mhm,
they can always come back to myself or someone with my company and say, "Hey, am I eligible to pull additional equity from the home?" I
mm,
tapped out what you gave me in the first reverse. It's not a
mhm,
one-stop deal. A reverse can be refinanced just like a conventional mortgage. And someone could even finance out of a reverse to a conventional, but you can refinance a reverse with a reverse and see if, for example, if property values went up, someone may qualify for more
mhm,
funds because they'll have a higher appraisal. Also, at that point, they would be older. And like I said, older borrowers qualify for a greater percentage of equity in general. And the
mm,
other big consideration is the
right,
current rates. So as you know, it's 2025. Rates haven't really gone very far ever since they jumped up a few years ago. So we're still in a high rate environment. So people qualify in general for fewer funds in this environment because rates are high and it's going to push through the equity faster. So that's why we're in the 40 to 50% range.
right,
If rates dropped, someone's older and their property appreciated, they could qualify to refinance for significantly more equity. Say it went the other way and the factors didn't work out for a
yeah,
refinance. Granted, that borrower couldn't pull more equity from their home to live on, but the good news is they're still protected by FHA and insurance if they're in a HECM. And even if they're not in a HECM, it's a proprietary loan, they're never going to owe that balance back for the rest of their life. They still don't have to make a payment
okay,
on that money if they can't afford to or don't want to, and they can still stay in that home. We just can't continue the supply of additional funds each month because they did tap out everything that they qualified for. So it's not like they have to leave right
got it.
away. It's just they have to reconsider if they can afford it without the flow of funds.
Okay, that's really helpful.
Mhm.
So you just laid out a number of different scenarios. So when you start working with the client, what's your process to identify the right fit? The type
Mhm.
of loan, or if they're a good candidate for a reverse mortgage.
So we have a thing on our team. We call it the three L's. So first one is listen, because you always want to find out
Mhm,
what brought that person to you. Why do they care about or want to learn about reverse mortgage? You want to know what they already know or
mhm,
what they think they know, because there's that demystification step in there. So listen to them, find out what their goals are, what they know, what's going on in their home, their family, their finances, a little bit of everything. Talk to them and build that rapport, of course, as well. But the next thing is the other L is learn. So you want to learn what they're trying to do and learn about what's their
mhm,
mortgage balance if they have one, what's their income, what's their credit situation. We get a little bit more into the loan specifics at that point in learning about that. And then the last L that we call is lead. So listen, learn, and lead. And so at that point, you would start presenting options to them and tell them, okay, the HECM works for you because your home value is this and you have a low mortgage balance. Or maybe I'd say, you owe too much on a mortgage for a HECM because of the cap to pay off your mortgage. So we have to look at jumbo programs. Or I might say, you're only looking for money for 6 months, and then you told me you're going to rent out your whole house. I may not even advise a reverse mortgage at all because of the initial costs. I'm not going to steer
Mm,
everyone into a reverse that I talk to. It's got to really make sense and play out in their time frame. And everybody's a little bit differently. So there's a process, but it's so customized for everyone that it diverges off a specific path very quickly once we learn about their situation. Similar to an estate planner, every client is a little different, or a tax guy, everyone's tax situation is
right.
different. Same with reverse, everyone's age is different, their home value is different. Everybody gets the same rate, but their goals and all of that is different. So the process is those three
Right.
overview points, and then we'll see if it's a fit or not and which program suits them best.
Got it. No, that makes a lot of sense because, I was thinking the same thing. When you get to the money and, age and all those, you add all those just different dynamics and factors in, and that
Mhm.
will drive, what makes sense for them, if it makes sense at
Right.
all. Or you might say a reverse mortgage is absolutely a great option for you based on
Mhm.
your, situation right now. What about, you just mentioned estate planning. That was a great segue, unrehearsed. So when, let's say, the homeowner passes, how does a reverse mortgage impact their heirs or their surviving spouse? Or, and this is where I'm completely in the dark. So this is, again,
Mhm.
thank you so much for the education.
Yeah.
How does that impact any different than a regular mortgage or someone who owns their property outright? Or does it complicate things? Or how does that work?
Well, on the estate planning piece, if I talk to anyone that's going to do a reverse or has a reverse and they don't have a trust in place, especially in California, that's the first thing I would tell them to go do is, if you're going to get some money from a reverse mortgage, put the house in a trust. If they've already
Mhm,
got a trust, we can do the reverse in the trust, keep it all the same way. It's very smooth, and that bypasses probate.
mhm,
The reason that we do that is because probate takes a lot of time. And when the second borrower of a married couple passes away, technically the reverse is due. And the heirs or the estate technically only have 6 months to start figuring out how they're going to pay off the reverse mortgage. And what a servicing company will
mhm.
do that might be different than a conventional mortgage is start the foreclosure process, and they're going to backdate it to the date of
Mm,
death. So it doesn't behoove a family member to kind of hide the fact that, both their parents passed away. I'm not going to say anything for a while. As soon as the date gets reported to the mortgage company, they're going to start the 6 month clock from there. And if you've got to deal with probate,
okay.
that's a good year right there. What you can do
Yeah.
is sign a letter of intent, say, hey, I'm working with a realtor to sell the house, for example. If you need a little more time, they will give you two different 90-day extensions. So that's in essence another
Mm,
6 months. So you can have up to a year to resolve a reverse mortgage.
wow.
But to get those extensions approved, you have to really show that you're doing something. They can't just
Mhm,
assume that they have a year. And the other thing kind of to know is, in that time period, the servicing company for the reverse mortgage is going to still send out timely foreclosure notices because they've got to document everything, and it is on a strict timeline. The main thing is that, we tell people, don't freak out over this.
mhm.
You know, as long as they know that you're in process to sell the home, it's just a formality. We keep close tabs on a real estate agent that's working to sell a home so that they're in communication with the servicing company. And then another big thing to know is that when a reverse mortgage is recorded with the county, they actually record the lien for a value of 1.5 times the original max claim amount, which is the same as the home value. So let's
Okay.
say a home value came in at 750,000 when they did the reverse. Maybe they only qualified for half of that. Like I said, we only give about 50%, but the
Mhm.
recorded lien is going to be for like 1.1 million.
Oh,
And I've had realtors call and say, "What's going on? Why did they owe 1.1 million on a home that's only worth seven, eight, 900,000. And we have to say, no, look at the statement. You can see the actual balance of the lien. The reason that's done is HUD said they don't want anyone else going and getting second place mortgages on a home with a reverse. It's actually against the program guidelines. So the procedure for all lenders is to record a reverse mortgage lien at a very high amount. So another lender is going to look at that lien and say, oh, well, I'm not giving you any more equity. You already have a lien for this amount. So
Right.
it's a safeguard to prevent people from exploiting the program, going beyond the HUD guidelines. So a safety rail. But it
Right.
can cause a little panic if someone doesn't know that that's the case.
Right. Well, those are some great guide rails because I mean, I could imagine that happening to someone who doesn't even know it's a problem because you probably have people coming at them. They want to give them a mortgage. So they don't
Right.
know what the rules is. So if it's built-in guide rails that they can't have a second, that's
Mhm.
probably a good thing. So people don't get taken advantage of and get into a trick.
Absolutely. Yeah, my
So
clients call me all the time because I tell them you're
uh,
going to get a lot of mail.
yeah,
People, it's public record. They can see if someone has a
yeah,
reverse mortgage. A realtor or an advertiser could ask a title company to pull every house in 3 zip codes with a reverse mortgage on it, and the title company can do it very
okay,
easily. So it is public record if someone were to search for it. So they get a lot of advertisements from
right,
all sorts of companies, sometimes even trying to look like HUD and FHA.
hmm,
Had a client the other day who thought she got a letter from HUD with their HECM department, and we
hmm,
investigated. I said, "What is on this letter exactly?" And I
yeah.
helped her out. It was a
Oh wow,
cleverly disguised advertisement. So
yeah,
they are always trying to get borrowers into another program or
yeah,
another loan. So I always advise them, my borrowers, just call me. We'll talk
yeah,
about it. Don't do anything and at least run it by me so I can help you out if
right,
it's a potential pitfall or not.
right. That's a great point because the advantage of working with you specifically is
Mm,
a broker with integrity and savvy is that
right. Well, I will
your
correct you. I'm not
client.
a broker.
Okay, so sorry,
That's okay.
consultant.
I will say, please
Sorry.
don't ever call me a broker. I'm a
Yep,
direct
sorry.
lender and a specialist. So,
Okay.
brokers, that's fine if you want to work with a broker, but they're a
Hmm.
middleman and they're not a specialist in reverse.
Got it.
So, a broker can take an application and talk about reverse because they're licensed, but they're
Hmm.
going to shop around a bunch of other companies and
Hmm.
just pick one, but they're not going to know your underwriting guidelines. They're not going to know the program specifications. They're not going to know all the little details about what happens afterward. So I would very much differentiate a direct lender versus a broker, basically on your level of specialization and underwriting
Hmm.
procedures. So I get really deep into all of that. I work
Yeah.
directly with the underwriters. A broker's just sending your paperwork off to a
Hmm.
processor who then sends it to an underwriting team and then just relays the message back. So it's an extra layer, and some people like
Hmm.
that. But I would differentiate myself as a
Yeah.
specialist from a broker in that regard.
Yeah.
Also, we don't have a call center, and I'm not a call center kind of person. So we're around after. We're not transactional. We're actually an advisor. And I tell my clients, my job is to guide you through this program for the rest of your life or the rest of the time you're in the home and to help your family out afterward. So they're kind of stuck with me once they get into the
Yeah.
program.
That's great. So I'm glad I made that faux pas because
Right?
that wasn't even on my question list, but that's a great point that you are start to finish with them. So you're walking them through the process. Once it happens, they're getting all these letters. They're on the other side of it, the state, or when it comes due, you're kind of helping them navigate all the other predatory type people who are going to jump in here, and you can
Yeah.
help navigate that process as well as really have kind of their best interest, as a specialist as opposed to a broker, but also not having a call center. You're their go-to person. You're their point of contact. You're not going
Mhm.
to get handed off to anybody else.
Right,
Is that correct?
exactly, yeah.
Okay.
So we're there for the long haul, which is really
Right.
nice. Yeah, I help out clients. Personally, I'm licensed in California, Hawaii,
Mhm.
Arizona, Idaho, Colorado, and Connecticut, and Washington now, actually.
All
And then our
right.
company is in all 50 states, but I can do them
Right.
directly there. I did it mainly to help people originally moving out of California,
Mhm.
because as you know, we see that a lot. especially
Yep.
here in the Bay Area. But yeah, I have clients in, those mainly Western states.
Right. That's great. So if somebody is accessing this podcast from somewhere else, if you're not able to service them in a state that you're licensed in,
Mhm.
you have colleagues that you could refer them to be able to take care of them and have the same
Absolutely.
type of service that you're describing that you do. That's great. So let's go to the dark side of not necessarily a negative, but misconceptions around reverse, because that's one of the things. It's like, what are the things that people hear about reverse mortgages that either may not be true or just maybe overblown?
Mhm.
Because I think a lot of times people don't pursue even inquiring about it because they don't think it's a good idea right out of the gate.
Right. And the big one, Tom, is the bank's going to take my house or the lender's going to
Okay.
take my house. Or I'm signing my house away right away. And, I think basically what I've explained through our conversation is that it is just a lien and it's only a portion of the equity. It's a pretty conservative portion of the equity compared to, say, conventional mortgage, 80% loan to value, for example. People
Right.
hear that a lot.
Sure.
Um,
Or
we
more.
give up to 50%. And the reason is because, yeah, if someone doesn't make a payment, that balance can grow and erode the equity. So on that dark side, people think, oh, I'm losing all my equity. But really, a lot of times the property is also appreciating in that time.
Mhm.
So that helps offset the equity erosion. It doesn't completely offset it. And it is market driven, but they think they're going to lose their house and they're really not. The family
Right.
can choose to sell the house afterward if they like, but FHA is there as insurance. Like, say the house is underwater and the borrower
Mhm.
passes away, the lender's going to go after FHA, not the heirs. So that should alleviate some of the dark side regarding that.
Right. That's a good point.
Children, of course, think I'm going to have no inheritance from mom and dad.
Mm. Mhm.
Again, if they pass away, both parents, all of the remaining equity that's untouched in the home goes to the
Mhm.
heirs or the estate,
Right.
wherever it's written that that money goes. Heirs can actually benefit from it. I mentioned the word pre-inheritance once
Yep.
earlier in our talk, where parents could actually pull money from their home and give it to their children as a down payment on their first home.
Okay.
And that's rather than waiting for them to pass away.
Mhm.
The parents get to see what their children do with the money. They're helping
Right.
them become a homeowner and build what I like to call generational wealth, right? Because generally, the
Mhm.
earlier you can get into a home, the sooner you can start building equity, stop paying rent, and build your own personal nest egg. Another thing people can do is purchase an income producing property with proceeds from a reverse mortgage. Like,
Mhm.
say they had a home in California, they pulled some equity out and bought an income producing property in Dallas, for example.
Mhm.
But that income producing property could be passed on to the family. So heirs can benefit from a reverse
Yeah.
mortgage. You just have to talk to someone that can show you how to use it as a tool
Right.
to produce that benefit and find a
Mhm.
solution.
Yep.
The big fears, though, going back to the dark side, is the loss of the home and the loss of the
Yep.
family legacy. And
Mhm.
and so it could just be a transformation of that family legacy. I've
Mhm.
I've read an article that said half of the millennials aren't even going to want the houses that their baby boomer
Mhm.
parents leave for them because it's an old house, out of date, it
Mhm.
doesn't meet their needs. Just
Right.
like it may have gotten to the point that didn't meet their parents' needs. Something else, people can do with a reverse I haven't even touched on is downsize or right size into a new
Oh,
property. You can purchase a home with a reverse mortgage, and I'll leave that for another day, but it is another option that people have.
okay.
There's a lot to say about a reverse
Yeah.
purchase. We've kind of talked about the aging in place
Yep.
half of the program, but there's a whole
Right.
nother world in that.
Got it. I did. So that kind of brings up, you allude a little bit to it, is, when is the time to approach you to start discussing this? It's, not waiting till you're in crisis mode. I need the money tomorrow, or maybe
Yeah.
that works too. I don't know how long it takes to qualify and to activate it, but what's the best time to, or is there a too early time, or when's the best time to reach out, to start getting the education and to get the process going?
I mean, it's never too early to learn about it. People will often spend a lot of time estate planning. They'll talk to their financial advisor or their tax guy or medically with doctors or like you with in-home
Mhm.
care. They spend the time to
Yep.
learn about the process. And I hate to say this is one more thing you should learn about, but when there is some time, it is a good retirement tool to learn about. So
Yeah.
it's never too early. You know, an old myth is, yeah, reverse mortgage is the option of last resort. And
Hmm.
if you think about that, why would you spend down all of your investments or 401k or other assets before you
Hmm.
touch your home?
Yeah.
For a lot of people, the home is the biggest asset and they want to
Yeah.
stay there. You
Right.
could take out a reverse line of credit at 62. You don't have to use the funds right away. Leave it untouched in the line of credit. And a
Hmm.
neat little feature that HUD put in place is called a growth rate feature on the line of credit. And the simplest way to explain it, because it's very unique in the lending world, I've never seen it anywhere else. The line of credit that's available will grow by the same rate as the rate of interest being charged on the balance. So it's
Oh.
not interest we're paying a borrower, but their available credit goes up every
Yeah.
year. Let's say they're paying 6.5% right now on the
Mhm.
balance. The
Yep.
available line of credit grows by 6.5% each year without reapplying, without refinancing or
Wow.
anything. And HUD put that in place so that lenders have less of an opportunity to come after seniors to make them refinance a reverse mortgage. So whether or not with a
Yeah.
HECM, if the house is increasing in value or not, that line of credit is growing. You'd show me a home equity line that's going to grow when
Mhm.
housing values go down
Right.
and tell me if that's not a good thing or not.
Right. Right. Wow. That's amazing. I mean, it seems to be, reverse mortgage. I mean, there's a lot of different components to it.
There's a lot. Yeah.
It just gives people more options. So if
Mhm.
they don't want to dip into a retirement fund or, and that maybe this is a better short or long-term option, depending on how they want to use it. Um, I mean, I had no idea just, and I've talked to you a couple of times about,
Yeah.
about this,
It's a lot.
but for somebody to get like, to really better understand based on their situation, to connect with you and to find out what the variety of options are and if it's a good fit for them to now or to have that in their back pocket in the future and already
Mhm.
have that relationship with you.
Right.
I think would be a really good idea. I mean, it's to inform yourself is huge. And I've been talking to a variety of different folks in the supporting successful or smarter aging. And I just think
Mhm.
this is just another one that there's the more you know, the better chance you have to live the quality and the type of life you want in your retirement or golden years. So, is there anything else, Dan, that we didn't talk about? We hit a couple really good nuggets there at the end that I didn't even have on the radar.
Oh, yeah,
But
we
is there
did.
anything else?
Usually people might ask, "What's the downfall?" Because all this just sounds too good to be true,
Yeah.
and I've did cover that, yes, it accumulates interest, and it can erode at equity if you don't make a
Hmm.
payment. You can always make a payment, but
Right.
also there are upfront costs with a reverse
Hmm.
mortgage. If you go the HUD, FHA, HECM route, the big cost is the FHA insurance. So I like to make that very clear to everyone that
Hmm.
you're paying for this insurance for the lifetime of the program. So
Hmm.
the benefits really play out more in the long term. Using a reverse mortgage that's FHA insured for like a kind of a bridge loan purpose, it would have to be the right fit, and we would talk
Hmm.
about that. But basically, a borrower pays 2% of the home's appraised value straight to FHA. It doesn't go to us
Okay.
as a lender,
Right.
it's directly for that insurance. So you want to make sure that you'll have the time in the program to reap the
Yeah.
benefits of everything that FHA insurance can give. There are origination costs and third party costs with reverse as well.
Yeah.
So even if it's not an FHA program, there are initial upfront costs. It tends to be on the higher side of financing options. Maybe a bank will do a no cost equity line for you,
Yeah.
but you need the ability to repay. Whereas a
Yeah.
reverse is expensive to get into. We finance all that cost into the loan so it's not out of
Yeah.
pocket. And we can qualify people much easier credit and income wise. So there's a few points that are different, and we get into that when someone's really learning about the program.
Hmm. That makes a lot of sense. I mean, I think whichever route you go, there's going to be the balance of the ups and the downsides of it, or like you
Yeah,
said,
I
a
mean,
reverse
nothing's
mortgage
free in
probably
life,
isn't.
right?
Yeah, exactly. And it's more of the right fit based on your specific situation. So to that point, I'm going to have all of Dan's contact information in our show notes and all the best ways to get a hold of Dan. And if you're not in a state that Dan services, then he'll be able to direct you in the right place to the right person. But I just want to say thank you so much, Dan, for today. This was really super informative, and I think people get a lot out of it. And again, this is such a great environment to just learn some key components of reverse mortgage, and then they can take the next step to see if their situation is worth pursuing the next steps, and not be scared to reach out to somebody and still be in the dark. So thanks for doing that. I think you've probably educated a lot of people on this.
Oh, well, thank you for having me, Tom. It was my
All right.
pleasure. Appreciate it.
Okay. Well, thanks everybody. And thanks for joining us again on Synergy Sessions, Aging Smarter in Silicon Valley. And we'll see you on the next podcast episode. Take care. Thanks, Dan.
You're welcome. Bye-bye.
Thank you for joining us on the Synergy Sessions. We know you have a lot on your plate, so we really appreciate you spending the time with us today. If you found the information in this episode useful, please reach out to the guest or the resources in the show notes. I know they would appreciate it and would love to help. Also, if you have an idea for a future episode, please reach out to us on Instagram or Facebook, or email us and let us know. We'd love to hear from you and provide information that's useful. Lastly, please remember, you don't have to do this alone.